What's up, guys? I'm Nobody Special, and I have a special guest back with us today. Is my good friend Joe Brown from Heresy Financial. It's one of my favorite financial channels on YouTube. And Joe is back with us today. We're going to talk about some recent events that we're seeing in the banking system, with the money supply, with Japan. There's a lot happening in the world right now. It can be a lot to take in. And Joe, in my opinion, is one of the best financial minds in YouTube. So he's going to help us translate some of this data in the charts and some of these stories, and maybe we can figure out what is happening and where we're going from here. So, Joe, thank you for being with us. And how are you doing today, sir?
Very good. Thank you for having me on again. I'm excited.
It's a pleasure. Welcome back here anytime. I'm going to go ahead and share my screen, Joe, and let's just see. First chart we're looking at here. This is USD JPY. This is the strength of the Japanese yen as measured against the US dollar. So as you see this chart moving higher, you're seeing the yen weaken. And as you see this chart moving lower, we're seeing the yen strengthen. So obviously what you're probably drawn to right away is over the last week or two, we've had a pretty significant strengthening in the yen. Now, a lot of that started with some intervention by the Japanese finance ministry, where they started dumping some of their dollar reserves to prop up their own currency. They timed it a little sneaky around U.S. inflation prints to take full advantage of it. But then yesterday, there were no talks about intervention. We saw the yen strengthen pretty substantially yesterday, and it continued this morning right up until we had a better than expected GDP print here in the States this morning. But we're starting to see the yen strengthen on its own without any intervention from Japanese authorities now, which has some speculating about the yen carry trade, that people are starting to cover their shorts in the yen. And I just wanted to pick your brain about this. What do you see playing out here, and where do you see the situation with the Japanese currency going based on your understanding of what's happening over there?
Yeah, absolutely. I would like to bring into this a story from the late 90s. I believe it was 98 or 99. There was a hedge fund called Long-Term Capital Management. And the guys who were running this fund, for anybody who's not aware, were Solomon, Black, and Scholes. These guys, if you recognize those names, it's because they won the Nobel Prize in economics. We've got the main major options pricing model named after these guys. They were brilliant. They were geniuses.
That's a pretty exclusive group, right? That includes Paul Krugman, that Nobel Prize winning thing. So
he's in good company. You'll see why at the end of the story. So these guys knew what they were doing. And they had this hedge fund that their main thing was relative value trades. Very simply, that means you take two things that are identical or as close as possible to each other as possible, and you are long one and you are short the other. So you buy one and you short sell the other. That would be like, it would be similar to like you looking at Google stock and you saying, okay, there's A shares and there's C shares. The A shares carry voting rights, the C shares don't, but they're both ownership of the same company. So percentage wise, these guys are always going to trade almost identical to each other. Which means that sometimes the performance, it'll differ because there's big blocks of buying and selling of the voting rights shares, but not of the other shares. So you might have discrepancies where the performance deviates from each other. So where there's outperformance by one group versus underperformance from the other one, you'd go long the one that was underperforming and short the one that was outperforming. And then when the performance comes back together, and again, that's why it's called a relative value trade, because you only care about relative value. They could both tank, but as long as they get closer in terms of total relative performance, then you can close out the trade. So you just care about the difference in performance. Whether they both go up or both go down doesn't matter. It's about the convergence and divergence of the performance relative to each other. So they long-term capital management started off with doing on the run versus off the run treasuries. So that would be like we've got U.S. treasuries that mature in 10 years. And we have, a 20-year treasury that was issued 10 years ago. So they both are going to mature on the exact same date. But for whatever reason, institutions want the new 10-year more than the old 20-year, even though they're the exact same thing backed up by the same government, expiring on the same exact day. So because institutions would load up on the new ones for whatever reason, the price discrepancy would, show up in a couple of pennies. So they would come in and they would go long one and they would short the other. And it's a risk-free trade because they're both the identical thing, essentially. The only difference is one was just issued, the other one has been around for a while. So because it was a risk-free trade, they were able to lock up a lot of leverage for this because there's zero way they can default on this. They're long one and short the other. So if one defaults, so does the other one. And they're short the other one. So risk-free trade, they got all the leverage in the world that they wanted in order to pursue this type of trade. And there was not enough of this type of trade for them to deploy all the money they wanted to. They were making crazy money on this. A penny at a time, you have to use a lot of leverage for that to make any significant money, but they had to venture out into other areas. So instead of just doing on the run and off the run treasuries, they would venture into, currencies versus bonds, and they would do, all sorts of different relative value trades where instead of two things that were virtually identical, being long one, short the other, they would be long one and short another of things that were close enough that historically should converge after a diverging of their relative value.
It feels like that risk-free element is starting to evaporate as we get close
yeah.
enough.
But they had models.
Oh,
you have to understand they had models.
Very proud of those models.
Yeah. So they kept on growing and growing and growing, and it got to the point where everybody was copying their trades as well because they were working so well. Well, a catalyst happened, and for the purpose of this discussion, it's not really necessary to look into that to discuss the details of that. But basically, some of their trades should have come back together in terms of their relative value, but they started to widen instead. It was like, these are the same thing. They shouldn't be getting farther apart from each other. They should be getting closer, but it didn't matter. They were getting farther apart. Well, the problem is then they hit their risk limits. So they're like, all right, well, now we have to close out. The people who have loaned us money are saying, give us our money back, close out that trade, because we don't want to be left with nothing. We want to be left over something. That's our risk limit. So when you're forced to close out a trade like that, remember, you're long the lower and you're short the higher, which means to close out, you've got to buy to close the higher one and sell to close the lower one, which actually makes that difference worse if you're trading in size.
The act of exiting the trade makes your problem even worse now.
Right.
Whoops.
Especially because you're closing out a portion of your portfolio because of that risk limit. You're not closing out everything. But by nature of closing out that first part, you make the rest of your portfolio more underwater. The other problem is everybody's in these trades now. So because this trade has gotten so popular, because it's risk-free, right? And it got to the point where this was actually the first orchestrated bailout of Wall Street by the Fed. The Fed gathered all the big banks together and said, deal with this, bail out long-term capital management. Otherwise, there's the risk that this thing within a couple of days could cascade and take out the global financial system. Like it's that crazy. So Wall Street did. They followed the Fed's advice. They pulled a bunch of money in together. They bought out long-term capital management, dissolved it, and everybody who was involved kind of walked away with their heads hung low, except for the fact that they still had, the fame of being Nobel Prize winners and the authors of the Black-Scholes options pricing model and stuff. But that's the that story is documented in a book called When Genius Failed by Roger Lowenstein. And it's a tale as old as time. Like this type of thing has happened more ways than you can count, where a risk-free trade gets entered into with leverage. It becomes extremely popular. And then when a catalyst happens that causes something to happen that shouldn't happen and makes the trade worse, everybody has to close out. And that makes everybody's losses even worse. A lot of times the reason why there is risk is because it cascades into other markets. When you are being liquidated, you don't sell what you want to, you sell what you can. So that's actually one of the reasons why this has bled over into some really odd volatility in other markets around the world, where you have other highly leveraged trades happening, like short volatility, and you've got gamma squeezes happening all over the markets, especially with tech, This is bleeding in everywhere as one thing that's high risk in reality that people thought was zero risk starts to get unwound. You have to unwind everything because your risk limits get hit very quick, and you get liquidated. You have to sell everything.
So yesterday, while we were watching the yen strengthen inexplicably, because there was, to my knowledge, there was no intervention happening yesterday by the finance ministry. So we're watching the yen strengthen, and also happening yesterday was just a bloodbath in tech stocks. Right, the Nasdaq sold off something like 655 points yesterday, biggest one day loss in the Nasdaq since the tech wreck of 2022. Could the two be correlated here? Could the unwind of the yen carry trade, which bears a striking resemblance to the long-term capital management situation you just described, could that have caused some forced selling in some of these high-flying tech stocks in the U.S. as they're closing out their shorts against the yen? They're having to sell U.S. risk assets to generate the cash to close out those shorts.
1,000%. I'm not saying that's definitely what happened, but it absolutely could be. And it seems like it is connected, especially considering the fact that one of the reasons why some of the biggest tech stocks had been flying up is because of a very similar type of trade that was happening, where you have a lot of retail traders that institutions are trading against right now, or building a position against, that is driving the markets higher. It's a derivatives play, and when that unwinds, the same thing happens. It kind of collapses as fast as, or faster than it even went up, which can absolutely wipe people out, and the institutions will be positioned against it first. So it'll be people getting wiped out, not big institutions, or at least not most.
Now,
But
was
yeah,
that
absolutely,
the
they can be
zero
connected.
DTE phenomenon you're talking about, that trade?
Yeah. So essentially, if I sell a put, this is a strategy that's been working for a while now, specifically on a stock like Nvidia. If I sell a put on it that expires today, let's say it's Friday, I sell a put. Well, then the only way that I get hurt is if Nvidia falls, and specifically falls beneath my strike price. But Nvidia has been climbing and climbing and climbing. And if you take into account some of the 0-day till expiration options that are more than weekly on like indexes, then you can repeat this trade more times in a week. Basically, I sell an option that has a very, very low likelihood of getting exercised because it is way below the current price. So it's a strike price that's way out of the money. So I get paid, let's say, 5 cents for that times 100. So, $5. That's for per contract. So I could do, 10 contracts, 100 contracts, whatever. If I do that, then the most likely scenario is that the option expires worthless, and then I just get to keep that money. The risk that I'm taking on is that I will have to buy shares of the underlying if it drops. So if Nvidia or SPY or whatever, if it starts to drop, then I may have to buy those shares. The thing is, though, I don't have to actually have enough money to buy all those shares if I'm trading this strategy. So this is called a naked short, or trading naked options, selling naked options. And if the stock does start to drop in that time period, then I have to probably close out really quickly before it gets to that point. Otherwise, my broker might be on the hook and not be able to collect that money from me because I just don't have it. The issue is that there are so many people participating in this strategy that what happens is there's nobody buying these things. For every trade to go through, there has to be a buyer and a seller. But if everybody's selling these options, then the question is, well, who's buying them? The answer is the market makers, because that's the market maker's job, is to make a market in that security. So they have to be there. Yeah, they're going to take a spread, like they're going to take, they're going to be the middleman. So they're going to take a spread. But what if there's nobody on the other side of the trade to buy it from you? Then they have to buy it themselves. And so how do they hedge themselves? Well, they just bought a put from you. How do you hedge a long put? You buy the underlying, because a long put is inversely correlated to long shares. And so they're neutral. They're not positioned to profit or lose based on market movement. They're delta neutral. And so they have to buy the shares. So if all market participants are selling all these options, that means that the market makers are having to funnel money in to buy the shares in order to hedge themselves, which drives the price up, which makes this trade continue to work. But at some point, something happens, and instead of people buying these things, or I guess selling these things, instead of this money coming into the market, this money unwinds, maybe because of the unwind of a carry trade or something like that. This whole thing collapses, and then everybody has to close out their trades. They owe money, they lose money, they get wiped out. Everybody's closing out. That's driving the price down extremely quick, and it unwinds the whole thing all at once.
So when you have a trade that's as crowded as this, and then you get things like Tesla and Google earnings, which were maybe the earnings weren't terrible, but the conduct of the executives on the conference calls was laughably bad. Google was asked a question, Google CEO was asked a question about the risks of overinvesting in AI space. And of course, his answer was there's more risk in underinvesting while our competition is investing in it. So it basically said, like, everybody's jumping off this bridge, so are we. And then you had Elon Musk, who, never mind the fact that we're not selling as many EVs and our auto margins are way down. Hey, we're going to have autonomous humanoid robots any day now. Another in a long line of promises that Elon likes to make. So you had a very skeptical market around tech CEOs yesterday. At the same time, you've got Japan, the currency strengthening as this carry trade unwinds, and you've got this incredibly crowded trade. Now you can see how the conditions for a very rapid and sudden unwind could be present. And the next thing you know, you've got a NASDAQ that's down 3.5% in one trading day. Now, it looks like the dip buyers may have come in this morning and buying it back up a little bit. We'll see where that goes. It's not necessarily like, the big crash that everybody's been expecting is automatically happening, because we've seen these corrections before. But that's one possible explanation for what happened yesterday. Now, I want to talk to you about another situation that involves Japan. I'm going to share my screen with you again here. And it's this story here I've noticed. First of all, we had this story. This is from back in the middle of June about a bank called Norinchukin in Japan. I believe it's the fourth largest bank in Japan. Some people call it Nochu. They took a big loss because they were caught off sides with bets on interest rates, right? We've seen this in the States and higher for longer, right? In the failure of Silicon Valley and Signature banks. I don't think Norinchukin is in danger of failing here, but they announced that they had a huge negative carry associated with bad bets on interest rate direction. And so they're unloading $63 billion worth of bonds, which was mostly US and European treasuries. But what was interesting about this story, what really struck me as odd, was that the firm mulls a shift into CLOs, or collateralized loan obligations. If you guys don't know, a CLO is super risky debt, right? CLOs are made up of commercial mortgages. They're made up of loans to zombie companies. This is some of the highest risk debt you can possibly buy. And Norinchukin is already known as the CLO whale. They have some of the biggest exposure to CLOs in the world. And here they are losing money on low risk treasuries. And they say, don't worry, we're just going to pile even more into this trade of CLOs. And this comes as a lot of banks are reporting earnings. We're seeing net interest margins, net interest income is getting squeezed. Even at the banks that are in good shape right now, net interest margins and bank earnings were all way down. The banks are not making much money on their loans, but they're having to pay higher interest rates on their deposits, partially the fallout from the banking crisis. So we've got a situation where banks are being driven to take more risk. They're chasing yield. And I saw this one. This is the CNN's Fear Greed Index. Right? It's not my favorite of the indicators, but it's decent. And this is made up of several smaller indicators that are all in either neutral or fear territory, except for one. One category is actually in extreme greed, and it's this one: junk bond demand. The spread between junk bonds and investment grade bonds is getting much lower, which means, correct me if I'm wrong here, Joe, people are overpaying for riskier assets, and they're not being compensated for that additional risk because the difference in the interest rates between the low risk and the high risk stuff is getting so small. And is this Is this also possibly a symptom of what's going on in Japan and how there's just no yield to be had in Japan? And so they're going all over the world looking for anywhere they can find yield, plus American banks being forced out on the risk curve to chase yield also. How do you see a situation like this playing out and what could go wrong here?
Yeah, absolutely. So there's kind of the short-term risk and the long-term risk. So the short-term risk is, similar to what we saw with like Silicon Valley Bank. It's like the the risk of, hey, inflation sticks around, rates stay high, the losses are piling up, and so to the extent that you can get out of the lower yielding stuff and get into the higher yielding stuff, the better. Then the other side of that coin comes in. Well, what if there's defaults, and especially with commercial real estate like office space, we're seeing losses pile up. So everybody's kind of just playing a big game of chicken right now. Real estate is trying to force banks to take the hit, take the loss, refinance. Banks are trying to see if maybe liquidations can occur to at least get their money back. So there are lots of problems everywhere we look. Long term, this is something where, as the cat was let out of the bag with the money printing that happened in 2020. We're in this longer phase now of, we're going to have volatility where there will be periods of time where inflation drops. There will be periods of time where rates drop. Over the long term, though, we're in this higher for longer environment because of like this is symptomatic of that. You have inflation sticking around, which means as a lender, I cannot afford to lend at 2%. I cannot afford to lend at 3%. So as my old debt matures that was loaned out a while ago at those low rates, I have to seek the highest rate possible, because if I don't, then I'm not going to get a return for my money. And I'm probably not going to get that in the safest investments. And so it pushes money into some of these higher yielding assets, which are inherently going to be a little bit higher risk. So we're seeing that dynamic play out. There are certainly higher yields available in things like T-bills, right? You can get 5% on T-bills. The problem there is, well, what happens if, in order to deal with the sovereign debt crises around the world, central banks start to lower rates? Well, then, I got 5% for a couple months. That doesn't help me for the next 5 years, because now I have that reinvestment risk. So when you have the ultimate driving factor behind all of this is, fiscal dominance. It's these sovereign debt crises around the world where governments are spending money that they don't have, which means they have to borrow, which means they have to pay more for it, but then they can't afford to pay more for it. So then they monetize that debt. That drives prices back up, which means lenders get screwed even more. This is a big government deleveraging taking place. And that's why the last time we saw this, interest rates and inflation both moved higher for decades, while government's debt to GDP actually moved lower. So this is a big inflationary deleveraging by governments around the world, which ultimately transfers purchasing power from lenders to borrowers. There are crises along the way, and so there's risks everywhere you look.
All right. So something jumped out at me in your answer there very early on. You mentioned in the short term, this is a game of chicken that the banks are playing by buying these risk assets. Tell me more about this game of chicken. Who is on the other side? What does it look like when one side blinks or the other? And what happens if nobody blinks? Which is what anybody who's playing chicken should be asking themselves. That's the kind of a scary scenario I see playing out when you phrase it that way.
Yeah, I mean, the old classic saying, if you owe the bank $1 million, you're in trouble, but if you owe the bank $1 billion, they're in trouble. And many small regional banks are in that position right now. And even Powell, last time he did a 60 Minutes interview, I think it was like 6 months ago now, maybe a little bit more recent, he was asked about small regional banks, and Powell's like, yeah, we fully expect that there will be plenty of small banks that fail. They're not systemically important, so it doesn't matter. The assets that are insured will be absorbed by a larger institution. And basically describing what a lot of us have been talking about for a long time, that banks are in trouble. And this is going to result in more consolidation of banking, like every single banking crisis has over the last couple of decades, that has resulted in fewer banks that are larger, that are now more systemically important, which means more regulation, more intervention, until we have basically a fully controlled, top-down, centralized banking system. But right now, specifically, the game of chicken that's taking place, office space, real estate, commercial real estate versus the banks. It's like, okay, I've got a big building and I bought it for, let's say $50 million. Right now, if I were to sell that building, because commercial real estate goes by the income that building can produce. Right now, if I sold that building, I might be able to sell it for, $20 million when I bought it for $50 million. And so that's a huge loss. So I don't want to do that because I owe 50 million on it, or maybe I owe 40 million on it. So if I sell it for 20 million, I still owe the bank 20 million. So I don't want to do that. I can't right now. I'm fine holding it because I've got a low interest rate. And so I'm barely making enough income to cover the debt service payment. But when I bought the building, I had a really low interest rate. Now interest rates are much higher. So my debt is due. It's maturing this year. And this is the case for most commercial real estate. Within the next 9 months, there's over $1.5 trillion of commercial real estate debt that is maturing. When that matures, I owe that money back, all of it. It's a balloon payment. So I either have to come up with $40 million to pay the bank and then figure out where to, where to get that from, which is unlikely. Or I have to sell the building and come up with $20 million, which is also unlikely. Or I have to refinance. The issue is if I refinance, that means I'm getting a new loan to pay off that old loan. My debt service cost is probably going to triple. And so based on the current income the property is producing, I cannot afford that new debt. So a bunch of commercial real estate investors are working with the banks right now and saying, hey, look, this is the situation we're in. You're not going to get your money. And so the bank is going to have to say, well, we'll just roll over your debt with the same interest rate. You owe it back to us. We're going to take the building, but now we have a building that is worth a lot less. So it's a lose-lose situation for everybody, unless the banks just decide to roll over. And there will certainly be banks that decide, yeah, we've got no choice. We'd rather have some income than, huge losses. But there will be other banks that try and win that game of chicken. There will be banks that go under. There will be commercial real estate developers that go under. There will be a lot of commercial real estate that gets very cheap. And there will be some carnage. Ultimately, it's not this specifically, in my opinion, is not a systemically important. There's no systemic risk going on here. We're going to see some big deals on big commercial real estate. We're going to see some banks collapse. As long as you don't have $250,000, more than $250,000 at a single bank, you're going to be fine. If you do have more than $250,000 in one single bank, go put the rest of it in a new bank account, spread it out. But as long as you don't have more than that, you'll just be absorbed into the new bank if your bank fails.
Now, you just mentioned the 250,000 FDIC limit. We haven't seen that exercised yet, have we? Every bank that failed for the last year and a half, right, since the March banking crisis, everybody got everything back, including the uninsured depositors, right? Even at that bank that just failed in Pennsylvania, in my backyard, Republic First Bank, which was a very small bank. I think it was like a $16 billion bank or something like that. Even at Republic First Bank, all of the uninsured depositors got everything back. So the FDIC has invoked the systemic risk exemption for every single bank failure of the last 2 years, even the little ones. At some point, are they going to be able to keep this up? Or, I mean, do you see them getting to the point? I mean, I know why they're doing that, because these are banks with a lot of percentage of uninsured deposits. And the argument is, well, if the uninsured depositors at this bank lose money, then the uninsured depositors everywhere will panic. And so we're evoking the systemic risk exemption. Well, then didn't you, through interpretation of the law, just effectively get rid of that $250,000 threshold from the FDIC by saying you're going to invoke the exemption every time? And then I guess we're just supposed to arbitrarily guess when you're going to stop doing that. And then from that point on, everybody loses money who's uninsured. The FDIC has been a little inconsistent with their enforcement of the law, I guess is what I'm saying. They kind of threw out Dodd-Frank with that.
Yeah. You are right that if they, probably with this last one, if they would have just let all the money over $250K per person just evaporate, a bail in instead of a bailout, then we probably would have seen depositors at most other small banks flee, go to big banks, and that would have resulted in a collapse of all those banks. So I think one of the issues that is being faced right now is, I mean, this is going to sound super out of touch, but $250,000, the reason why that limit was set was because it was supposed to be an amount just for the rich. So they didn't want to bail out the rich. But nowadays, especially a lot of people who are scared of risk assets like the stock market or real estate because of the last 15 to 20 years, a lot of people do carry, unfortunately, which I think it's a huge mistake, most of their money in the bank. And certainly for most Americans, it's not that much. But for most banks, most of their assets come from a few of those high net worth clients. And so if you don't implicitly guarantee above 250K, then there are going to be a lot of banks that fail just because without those few clients, the rest of their clients lose them money. When I was a broker, it was astonishing. Like every institution tracks this. You can look at every single customer and see how much money you've made from them over their entire lifetime as a customer. And so like I could look at a client and I could say, okay, you've called us this many times. We pay this much for this phone software service. And so you're responsible for X tiny percentage of this. You talked to our customer service representatives for this many hours over the last 10 years. You've been a client of ours. We paid each one of them this many dollars per hour. You made this mistake that we guaranteed and we've refunded you this and blah, blah, blah. And over your entire lifespan, even though you've had your money with us for X amount of years, we have lost $6,000 on you being our client. We have lost $300 on you being our client. We've made maybe $1,000 on you being our client. So for the vast majority of people, because they have so little assets, you've got $10,000 in your savings account. It's like, you're not paying bank fees on that. You're not paying overdraft fees on that. You're swiping your debit card. Those fees are going to Visa. It's like the vast majority of people's banking relationships are not profitable or very, very, very tiny profitable for the bank. Banks don't make any money off that. Where they make their money is the high net worth clients. And so you've got your 1% or maybe your 5% of your clients that make up all of your profit. Those guys have way more than $250,000. And so if something happens and they get spooked, all of those banks collapse. It doesn't matter about the other clients. They don't make any money from them.
So I kind of have this vision of, the banking system is the Titanic, if you will. Sorry for the doomer analogy here. I'm sure I'm going to get a lot of heat for it, but the boat's taking on water. And so the first class passengers are getting the first seats on the lifeboats and we're letting them take their luggage with them. We know there's not enough lifeboats for everybody. The deposit insurance fund can't possibly guarantee everything. It's a confidence game. And the argument is, well, if we tell the rich they have to put down their luggage before they get on the lifeboat, the rich people might panic and there might be clamoring on the deck for the few seats that are there. And then everybody will panic and things will be all just terrible. And so we're going to let the rich people take their luggage with them so we have an orderly loading process of the lifeboats. Well, that's overlooking the fact that means we're going to run out of lifeboats a hell of a lot sooner if it turns out we really do need to evacuate more people off of the boat. So it does come with a cost, and I understand 250,000 is not a very big number these days. And that also includes a lot of business clients who maybe they're not wealthy, but it's a business account. So 250,000 is not a lot of money for a business account that has a lot of accounts receivable and payables involved. But it does seem like there is this underlying weakness in the banking system, and we're just being told arbitrarily everything is strong and resilient and well capitalized. And then at the same time, oh yeah, there's going to be some bank failures. And every time one of them fails, we're going to evoke the systemic risk exemption to stop a panic. So the actions and the words don't always line up.
Yes and no. So the analogy, I like the analogy. Here's where because all analogies break down at some point. So here's where this one breaks down. It's that FDIC actually has no money.
Oh,
And
great. Even
so
better.
yeah, so even if they were to do this, like, and only save the 250,000 and under, it's like they still don't have them. They have some treasuries, but guess what happens when they sell off those treasuries to get the cash? It makes all the other banks' loss worse. Number one. Number two, they're not actually tapping that. The Fed, at the end of the day, is printing the money for this. And so when you look at like the lifeboat analogy, it's like technically there's an infinite number of lifeboats. It's just how many lifeboats the Fed chooses to print. So when you look at the money, let's look at the money supply as like an example of what I mean by this. Let's say you allow the banks to fail, like you should. The money supply would drop off a cliff because that money people think is there. So right now it's counted in M2. But if the bank fails, everybody realizes the money's not actually there. So the money supply immediately drops by the amount of money that that bank had, because it's all just IOUs. It's not actually there. Your $10,000 in your savings account, that's been loaned out. It's not actually there. If you and everybody try and go get it, you'll realize you actually can't. So the money supply would drop off of a cliff immediately. So there would be deflation that happens. What they do when they rescue a failing bank and save the deposits is when that money evaporates, they go to the new accounts that are opened up at the new bank and they print the money to refill those accounts at the same amount that just got destroyed. So the net result with the money supply is that it doesn't change. Say they print up all the money that just got destroyed. So yes, prices stay higher than they would have gone otherwise. There's not any net new money or net new inflation as a result, though.
Okay. That's pretty good. I think that was meant to make me feel better. I don't know that it necessarily had the desired effect on target, but it was a good explanation. And you stuck with my analogy, so I'll take it. I know your time is limited, Joe, but I promised my people on Patreon that I would talk to you about money supply when I got you back on the channel. And so we're looking at the M2 money supply chart right now. Let me make sure I shared it. Can you see that all right? Yes. Okay. Money supply started falling right around April of 2022 as quantitative tightening and rate hikes took hold. They noticeably, we've talked about this before, the money supply stopped falling as quickly after the banking crisis in 2023. See earlier discussion about the lifeboats. Then I noticed that the money supply kind of pivoted right around Halloween on October 30th of last year. And now the money supply has been slowly growing pretty much since the fall. And before I open you up on this one, I want to also show you this chart of the Chicago Fed National Financial Conditions Index, or NFCI. And, the common refrain is that the Federal Reserve is in restrictive territory right now, that we have tight monetary conditions because of the higher interest rates and because of the quantitative tightening. But according to this is the Fed's index that measures overall financial conditions in the market. We're actually in very loose financial conditions right now. We're actually looser than we've been since the beginning of 2022, when we were just getting underway in the tightening cycle. And these conditions have been falling since March of 2023, since the banking crisis hit. So what is going on with money supply and what is going on with financial conditions? And how does that relate to what we're seeing in banks and inflation and everything else going on in the world?
Yeah, absolutely. So let's start off with the money supply. The one thing that is so frustrating about this, if you go back to the money supply chart, hover your mouse over that very last data point. It was just updated, and that last data point is from July 1st.
Correct.
We won't see this update for another month from now. And so the soonest, most recent data that we have is 1 month. And for the next month, then it just gets stale. So anytime you look at the money supply, you're either looking at it 1 month old or up to 2 months old, somewhere in there. And when it refreshes, the newest it is 1 month. So it's very frustrating that this takes, that there's such a delay here. And so when you look at, the money supply was falling, it wasn't until like November where it became apparent that the money supply had stopped falling. And it wasn't until like January or February of this year that it was apparent that had started to grow. Because by the time that January information is up there, it wasn't showing there until it was February. And then to notice a longer term trend, to know that you're not looking at like a fluke where it's just like a bounce in the data, you're looking at, 6 months. So it's frustrating that it takes so long for us to get this information. But it is clear that over the last 8 months now, the money supply has been growing. That's been largely driven by bank lending. But if we look at the financial conditions, which have been loosening as well, I think one of the main drivers of that is the Fed's stealth QE. And I'm calling it stealth QE, even though they have technically been doing quantitative tightening. So if we look at their balance sheet, they've been allowing assets to bleed off of their balance sheet.
So can I pause you real quick, Joe?
Yeah.
I'm going to bring up this chart. This
Okay,
chart is a screen grab from your video about stealth QE, which I'm going to put a link down below in the description for you guys watching so you can check this out, because I found this to be eye-opening when I saw this chart. This was really excellent work. Please go ahead.
Yeah, so this, if in total, from the yellow all through the red, is of their balance sheet, how much they own in U.S. Treasuries. So you can see that their total holdings of U.S. Treasuries has been on the decline for a while now. I think the top was, again, like that was April of 2022 or something like that. So it has been on the decline. But this chart has it broken down by maturity. So you can see that the short-term T-bills, they hold the same amount. So every time one matures, they roll that over and buy a new one. So they're not on net reducing their holdings of T-bills. Same thing with the green section. The purple section, they've shrunk a little bit, but again, it's under 1 year. So all the T-bills, they're basically just rolling them over. The real main section that they've done the majority of the shrinking of their balance sheet from is that orange and blue section. So that's treasuries that mature in between 1 and 10 years. So those are the ones that they're actually not rolling over and or net selling. So anytime one matures, that cash just gets, destroyed. It just ceases to exist. And by maturing, it means the US government pays back to the Fed the money that they owed them. The yellow section is the real kicker here. You'll notice that ever since 2020, this yellow section has continued to grow, even once everything else started to shrink. So these are treasuries that mature in over 10 years. So on net, the Fed is still buying treasuries that mature in 10 years or longer. Which means that, yes, they're allowing some of their other treasuries to mature. Yes, they're selling some of their other treasuries, but they're using some of that cash to increase their holdings of these maturities over 10 years. So what are the ones that are getting banks into the most trouble? Well, when you look at like the 10-year, the 20-year, and the 30-year treasuries that were purchased in 2020 and 2021, when the Fed said we're not thinking about raising interest rates, so banks loaded up on them, and then the Fed raised interest rates. It's like those are the ones that caused the banking problems in the first place. So this is the Federal Reserve engaging in like an Operation Twist. They're shuffling their balance sheet composition to help financial institutions unload those treasuries that are that nobody else wants, and they're replacing them with highly liquid treasuries that are of much shorter maturities. And so this does increase liquidity conditions, because liquidity is all about like the ability to sell something at its value you bought it at to anyone, anywhere, at any time. And so when you look at something like a house, it's very illiquid. Like it takes, months sometimes to sell a house. Even in a hot market, it might take, 4 weeks. So houses are extremely illiquid versus something like cash, like dollars, they're extremely liquid. You can just get rid of them. So the T-bills, the treasuries that mature in under a year, those are highly liquid. So they're used basically as cash by institutions versus the longer term treasuries. Those are becoming increasingly less liquid, especially as interest rates stay high. So this increases liquidity in the financial system as the Fed takes up and absorbs those longer term ones and replaces them with the shorter term ones that can act more as cash.
So, and again, I was really blown away when I saw this chart in that video, which was very well done. What they're doing, they're still effectively doing QE on the long end of the yield curve, because they're still net buyers of 10 to 30-year treasuries, according to the yellow section here. which means they're bidding up the prices on those treasuries and pushing down the interest rates on those. By the way, interest rates being pushed down, that's things like homes, right? So they're putting upward pressure on the price of houses when they do this because they're suppressing interest rates on the long end of the curve, which is more of a direct input to mortgage rates. But at the same time, they're also net sellers of the short duration stuff, which pushes the prices down and the interest rates on those higher. So the Fed's actions here is further inverting the yield curve, or at least putting more pressure on the inversion of the yield curve, which is part of the thing that's making the banks struggle here with their net interest margins, because banks borrow short-term and lend long-term. So everything the Fed is telling us they're doing, if you actually get into the nitty-gritty of how they're executing it, it's actually having the opposite effect on the segments of the market that they pay lip service to, like, oh yeah, affordable housing, even though we're suppressing mortgage rates, which just clears the way for home prices to rise even more. And the inversion of the yield curve, yeah, our banking system is strong and resilient, and there's going to be bank failures. We're creating the conditions to fail those banks by inverting the yield curve. I was really blown away by this, Joe. And I mean, is this why financial conditions keep loosening? Is because the long end of the yield curve more impacts the financial conditions, and that's what's getting us with charts that look like this, and ultimately leads to expansion in the money supply. Because while they tell us they're tightening, they're really loosening, leading to more credit expansion.
I think it's definitely a huge part of this. Credit expansion requires the collateral to do so. So by taking out of the market less liquid securities and replacing them with more liquid securities where there's a high demand for them, absolutely has a big contribution into financial conditions easing. So, I mean, hold on to your pants for if and when they lower rates and stop shrinking their balance sheet, because once they stop shrinking their balance sheet on net, they can do this even more, which is shrinking the rest, one part of it faster in order to rebuild this other part longer, even though the net amount stays the same. They've got, $7 trillion to work with and shuffle around as the financial system needs it or shows signs of cracking here or there.
Wow. That was a really, really well done video about stealth QE, and I found that chart to be very informative. And there was a lot of pieces fell into place. Joe, I could keep you here for another hour and a half if you let me, but I know you have to get going. So I'm just going to say thank you so much for your time and for your explanations, your sharing your expertise with us. Guys, that's Heresy Financial. I'm going to put a link to his YouTube channel down below. Highly recommend you check that out. He's one of my favorites. And Joe, I'll give you the last word if you want to wrap that one up. Anything you think we missed?
No, I just always want to encourage everybody, that financial literacy is money doesn't solve every problem, but it does solve every money problem. And most problems are just money problems in disguise. And so I think if we all were financially literate and did the right thing with our money, it would solve a lot of the problems, both individually and around the system. So keep learning, keep your eyes open, and stay intelligently invested and intelligently hedged, because I'm expecting a lot more volatility in the upcoming months.
Outstanding words of wisdom to end on. Thank you so much, Joe, for being with us. Once again, folks, check out the links down below to Joe's channel. And everybody, until next time, live small and dream big.